Hi, everybody. It's Dr. Robinson. Today is November 18th, 2023. I'm going to present something to you. I prepared it a couple of weeks ago, but then I got sick. I had the flu, maybe some laryngitis with it and stuff, maybe some strep throat, who knows. But my voice is getting a little bit better, still a little scratchy and stuff, but I did put it off for a week. So I wanted to kind of do this presentation to kind of show you or talk about something that happened way back on the 9th of November, which was a Thursday, if I remember correctly. So I wanted to talk about it and what impact it might have on the U.S. Treasury going forward, and on interest rates in particular. So I wanted to go through that. So we're going to take some time here to talk just about that for the day for today. So to talk about the Treasury market and how the government issues debt, we have to basically talk about the bond market. So let's review how the federal government issues debt to fund its operations. There are three basic types of debt that the government can issue. We call these things treasuries, by the way. So there's three basic types of treasuries. We have T-bills, and the T, by the way, just simply refers to the treasury. We have treasury bills or T-bills. These are bonds of a specific type. We'll get to those in just a moment. We have T-notes, and then we have T-bonds. We do not interchange these words, by the way. So a note is always different than a bond. You'll never hear a bond trader talk about a note as a bond. Now, again, in a general sense, they are bonds because a bond is a different type of investment versus equities or stocks, by the way. But we don't call them bonds. We call them notes if they're a certain type of bond. So we have bills, notes, and bonds. And basically, the word we use describes the maturity of that treasury. For example, T-bills have various maturities up to 52 weeks. So 52 weeks or 1 year is the maximum. There's no such thing as a T-bill greater than 52 weeks. So I get people saying, hey, Richard, is there an 18-month T-bill? No, there's no such thing because 18 months is obviously greater than 52 weeks or 12 months or something. So there's no such thing as an 18-month T-bill. So T-bills have different maturities. Now, again, the government puts out different types of T-bills. There's a 1 month. We call it the 4 week, by the way. We don't usually use the word month in these. So we call it a 4 week T-bill. There's an 8 week T-bill that would, of course, be 2 months. There's a 12 week T-bill. Of course, that would be the 3 month T-bill. You can get a 6 month or 26 week T-bill, and then, of course, the 52 week T-bill. So T-bills come in different flavors for different things, but they're always very short, no more than a year ever. The next type of treasury is called a note. So T-notes have maturities of no less than 2 years and no more than 10 years. So any treasury between 2 and 10 years is a note. It is not called a bond. So again, in generic terms, we might say refer to it as a bond, but in specific terms, in the bond market or especially in the treasury market, this is always called a note. Now, the government puts out different kinds of notes, of course. We have the 2 year note, we have a 3 year note, a 5 year, a 7 year, and a 10 year. Those are all notes, they're not bonds. So these are all things that go from between 2 and 10 years. By the way, you will notice that there is nothing between the 1 year T-bill and the 2 year note. So again, there's nothing in the marketplace right now for, let's say, an 18-month treasury, a 22-month treasury, anything, any of those weird numbers you might want to come up with. There isn't any. So if a T-bill is too short for you, the only thing you can do is move up to the notes, and they start at 2. The last type of treasury is called the T-bond. Now, the T-bond, again, have various maturities, but they start above 10 years. So we have traditionally, we have a 15-year treasury. Occasionally, the government does a 20-year treasury. They don't do it very often. But the most common treasury most people are familiar with is a 30-year treasury. That's the longest the government does. The government has thought about doing some longer bonds. Some people have asked, why don't we do like a 75-year bond? Some countries do, by the way. But in this country, we have never developed a 75-year bond for various reasons. But so basically, there's really kind of only three types of T bonds that we have: the 15, the 20, and the 30. Now, just a note down there at the bottom, it says individuals may call each of these instruments bonds, and that's true in the generic sense. So if we're talking about the difference between bonds, for example, and equities or stocks, then you can use the word bonds. But when we're talking about Treasury specific, we don't use the word bonds on anything other than an instrument, a Treasury, with a maturity greater than 10 years. Right. So economists and bond traders never use the generic term bonds to describe anything other than a financial instrument greater than 10 years. Now, there's a couple of other types of issues or treasuries the government can put out that are less important to our discussion, so I'm not really going to cover them. But there's something out there called a TIP, which is a Treasury Inflation Protection Securities. These things started out in 1996, I believe it was, when Bill Clinton was still president. Of course, one of the biggest drawbacks to buying treasuries is the low yield and their susceptibility to inflation risk. So remember, if inflation's at 3%, I have an ambulance going by, so it's going to get a little loud behind me. I apologize for that. But if inflation's at 3% and the bond only pays 2%, you're actually losing money. So one of the things they did in the 1990s when Bill Clinton was president was try to come up with a way to kind of encourage people to invest in Treasury. The biggest complaint people had is it's not keeping pace with inflation. Why would I want to buy something that's going to lose value or lose ground over time? So they adjusted these to inflation. We're not going to get into them, but they're out there. Of course, there's another type out there called the floating rate, a floating rate note or FRN. And a floating rate note is what it sounds like. If you're familiar with mortgages, of course, some people get adjustable rate mortgage, which means rates could go up or could go down depending on what's going on in the economy or what's going on in the marketplace or what's going on over time. So the government uses those as well. But they just don't use these to the point where people buy them is a legitimate way to fund government operations. So the Treasury has or holds about 300 debt auctions every year to raise money. And pardon if you're a big state guy, I'm going to offend you here a little bit, but we need to raise money for our fat, stupid, lazy, and gluttonous Uncle Sam. Uncle Sam has a voracious appetite, and he spends money on the stupidest stuff sometimes. So, and we all, every family in America has one of those uncles that's just, you kind of look at him and think, how did you survive long enough to live long enough to be somebody's uncle? But the Treasury is raising money for Uncle Sam, and Uncle Sam has a voracious appetite, especially for other people's money. So what we're going to do is talk about how the Fed, or actually technically how the Treasury, raises the money to keep Uncle Sam fat and happy at the dining room table or at the buffet hall or whatever it is wherever he's sat his fat butt at. So government treasuries can be bought by individuals or institutions. Now, as we go through this, we're going to talk about some technical terms. Pretty simple though. When you go to the treasury market to buy treasuries, you're either an individual, you're buying it for yourself, or you're an institutional. You're a hedge fund, you're a mutual fund, you're an insurance company, you're a big company that's got a lot of money, maybe you're managing money for other people and stuff. So you have access to the treasury market as an institutional investor. Now, individuals, let's talk about the individuals first. Whenever you're an individual and you go to buy a treasury from the government, you buy what's called a non-competitive or place what's called a non-competitive bid. In other words, you only have say in the maturity of the issue, you have no say over what the interest rate is going to be. It's non-competitive. So you're basically going to the government saying, here's $1,000 or $10,000, whatever it is you're going to do. Here's $1,000. Give me a bond. And the government, of course, will give you a bond. But the interest rate may be higher or lower than what you expected based on different factors. Let's call them market factors. But individuals always place non-competitive bids. Now, institutions can place non-competitive bids too, but they rarely do. Why would they? Because it puts them in the same class as the individuals. And individuals, as you know, don't get treated as well as the institutions because that's where the big money's at. So institutions generally place a type of bid called a competitive bid. So it's the opposite of the non-competitive bid. So here the buyer specifies an acceptable coupon. Now remember, again, technical term, but coupon just simply means the interest rate on the bond. So let's say, let me just throw out a quick example. Let's say the government wanted to issue $1 billion of 30-year treasuries, and that's going to be based on that. Now, they don't actually set the interest rate. The interest rate is going to be based on supply and demand. So the interest rate's kind of, we know what the approximate interest rate is going to be because it's always going to be right around where the current rate of interest is on a 30-year bond. But this particular bond could be higher or lower depending on demand and all, a lot of other factors. But in general, we kind of have an idea of where that price is going to be. So let's say the current interest rate for a 30-year treasury, and I'm just making stuff up, guys. Let's say the current rate is about 5%. So an institution could come in and say, well, we would like to buy some of these bonds, but we want an interest rate of 5.05 or 5.1 or 5.2. So they can ask for a higher interest rate. Now, whether they get it or not depends. It depends on a lot of different things. It depends primarily on the demand. There's a possibility that the demand for the bonds right at 5% is so high that anybody who wanted an interest rate of higher than 5 is not going to get it. That's a good thing to the government, by the way. It keeps interest rates lower. But on the other hand, if the demand is too low, there's a possibility that somebody who had, let's say, a 5.2 or even a 5.3 interest rate, they might get that because the demand for the bond issuance was so low. So institutions place these constraints on the government. Here's what I'll take, nothing less. So the government's like, okay, well, we'll put your name on the list, and if we need you, we'll use you. But if we don't need you, and we hope we don't, but if we don't, you're out of luck. But that's what the institutions do. So they do what's called a competitive bid. They've kind of told the Treasury what their interest rate is, what their minimum interest rate is, and if they can't get the minimum interest rate, they're not interested in the bond or the issuance. I shouldn't call it a bond because it could be a 10-year. That would be a note. But they're not interested in that particular treasury, right? So as we move forward, it's important to remember the difference between non-competitive, that's you and I, if we're mom and pops or your grandparents who are buying bonds, and then the institutions, the pension plans, the mutual funds, the insurance companies, the banks, and all the people who have billions of dollars to invest, as opposed to you and I, where we're buying 10 bonds at $1,000 each, type of thing. Important point here. Before an auction happens, the institutionals can trade in advance of the actual auction. Now, this seems like on the surface to not be fair, but this is actually a good thing. Because one of the things that happens is if you're an institutional investor, you're not investing, buying 10 of these at $1,000 each. So you're spending or investing $10,000. That's not what they're doing. They're investing billions. And they want to have an idea of what interest rates are going to be. If interest rates are going to be too low, then they're not going to be interested. They don't want to tie up, let's say they've got $1 billion to spend. They don't want to spend $1 billion with the risk that the interest rate on this bond might only come in at 3.5. So maybe it was at 5, and when interest rates came out, but the demand was so high that interest rates fell to 3.5, and now they've locked up $1 billion at 3.5% as opposed to 5%, and they're not going to be happy. So they want an idea ahead of time what those interest rates might be. I'm not saying what they're going to be because nobody knows what they're going to be. But this is how they gauge that. They can gauge this or gauge what interest rates might be based on the amount of interest in this issuance. How much demand there is for this issuance. If there's a big demand, they may want to come back and say, you know what, we're not interested in this one because there's such a high demand, interest rates are going to fall, and we're going to tie up our money, especially on a 30-year bond, because now you're tying your money up for 30 years. But interest rates might fall too far, and now I've tied up my money at a low interest rate for 30 years, and there's nothing I can do to get out of it other than to sell it to another investor, and I may have to take a loss if that happens. So when they trade ahead of the actual auction, that's called the when-issued market. Now, I know this is kind of technical, and it doesn't make any sense sometimes, the way we name things, but it's called the when-issued market. So these are people who are basically saying, here's the minimum. I want to trade this, or I want to buy this potential treasury, but I wanted to have a good idea of where interest rates are at before I commit to it. So I want to have some access to the market ahead of time. And so the Treasury gives them that access. So these things will trade in advance of the actual auction. So the auction we're going to talk about a little later happened on Thursday, November 9th. Well, on maybe Wednesday, November 10th, this auction was actually kind of already going on, even though it was not technically going on because the auction didn't happen until, it is a Dutch auction, by the way, so it actually happens at like 1 o'clock on every day that they do an auction. It happens at 1 o'clock, so this would have been 1 o'clock on Thursday Eastern time. Well, on Wednesday, these institutionals are kind of circling around saying, hey, what's the demand here? So the Treasury gives them information about what the demand is for this bond between the institutional investors so they can gauge how much interest there is in this bond so they can know whether interest rates are going to hold pretty high or whether they're going to fall or maybe they shoot up high. Who knows? But at the end of the day, they want access to this and the Treasury gives them access to this. This is called the when issued market. This becomes important later. We're going to stop talking about it for the moment. We'll come back to it in just a bit. But this is called the when issued market. Now, once the auction actually begins, it's a pretty straightforward process. It is a Dutch auction, which simply means the Treasury basically says, who will give me, and I can't do the auction voice here thing, but who will give me 10, who will give me 20, who will give me, that type of thing. So the Treasury issues a specific maturity. Now, on this particular day in November, they issued the 30-year bond. So they'll issue a 30-year bond or any maturity that they want. We'll use the 30-year T-bond as the example with a generalized coupon goal. Now remember, I'm telling you, it's not an actual interest rate. We're not specifying the interest rate because there is no interest rate to specify because, again, the interest rate that's going to be issued on this bond is going to be based on market demand. If there's a big demand, the interest rate could be lower. If demand is low, the interest rate could be higher. Since there's no way to know what the actual demand for the issue is going to be, the Fed or the Treasury basically says, we're going to issue a 30-year bond. Now, do they have an idea of what the interest rate is going to be? And the answer to that is yes, because it's probably going to be close. Not probably, it's going to be close to where the current 30-year Treasury is at. Remember, if a 30-year Treasury is trading at 3.7 or at 5, let's just use the 5%. If the 30-year Treasury is trading at 5%, it's pretty safe bet that if the Treasury wants to issue more 30-year bonds, they're probably going to have a coupon right around 5%. I'm not saying exactly 5. It could be a little higher. It could be 5.05, could be 5.10, could be 5.15. But it could also be 4.9 or 4.8, maybe even a 4.7. If the demand is high enough, it might actually go down to 4.7 or 4.6. And that, of course, the government loves that because the Treasury is saving money. Taxpayer money is being saved because the interest rate's lower, and therefore the debt repayment is going to be lower. So the Treasury is hoping for a big demand. Whether they get it or not, nobody knows in advance. Right? Now, that's what the when issued market is trying to predict. But of course, at the end of the day, nobody really knows. Now, the Treasury will hold an auction to raise a predetermined amount of money. Let's say Joe Biden wants to give Ukraine another $1 billion in aid. So the Treasury needs, in this example, needs to raise $1 billion. So they're going to hold an auction. It's a Dutch auction, and they're going to raise $1 billion in 30-year bonds. Now, again, we don't know the interest rate yet. We know it's going to be somewhere right around where the 30-year Treasury coupon is currently at. Let's call it, again, I'm going to call it 5 in my example. I'm just going to run with a 5. So I know that the rate's probably going to be right around 5. It could be a little higher, it could be a little lower, but it's going to be somewhere right around 5. So the Treasury knows that they're going to raise about $1 billion at roughly 5% interest rate. And of course, they know what the payments on that bond is going to be, so they know how much money they have to set aside from taxes and other future borrowings to pay that money back and stuff. But that's how this Treasury auction works. The Treasury automatically, now once the auction begins, the Treasury automatically accepts all non-competitive bids. So all of the bids from the individual investors, your grandparents and anybody else who's buying bonds, those are automatically accepted. Now, do we know what the interest rate is? No, not yet. But what the government does is the government automatically accepts the bids from all individual investors. and anyone else. And by the way, remember, sometimes it's not common, it's actually rare, but sometimes institutionals do non-competitive bids too. So if an institution did do a non-competitive bid, theirs would be accepted as well. So the Fed is going, or the Treasury rather, is going to accept all of the non-competitive bids up to the $1 billion limit. Well, what happens if there's $2 billion of people or $2 billion available, but only $1 billion of bonds available? The Treasury stops us at $1 billion. They're not going to keep it open and take the other money from the other $1 billion, out the individual investors who are willing to put up an additional $1 billion. The government doesn't work that way. Once they reach the $1 billion limit, the auction is done. So if they can reach the $1 billion limit with non-competitive bids, then the competitive bid guys, the institutionals, they don't get any chance to buy this auction at all. So they're SOL. But that's rare. Most of the time, the individual investors don't come anywhere close to being big enough to cover the issuance completely. So if the Treasury issues the full $1 billion from non-competitive bidders, the auction is over as the Treasury has sold the entire issue. Again, whatever that limit is, in this example, $1 billion, once you get to the $1 billion, the auction's over and everybody else goes home. If the Treasury doesn't receive enough bids from the non-competitive bidders, the auction will continue with the competitive bidders. This is where it starts to get a little bit fun. So let's say the Treasury was only able to sell $250 million in non-competitive bids out of the $1 billion that they were trying to raise. Well, if they only sold $250 million of the issuance, that means $750 million did not get issued. They weren't able to sell the $750 million of other bonds that they were looking to issue. This is where they turn to the competitive bidders. And that's where I say this is where it starts to get fun. The Treasury now turns to the competitive bids from institutional investors. So let's say the Treasury receives the following competitive bids, and I've just made these up. So in addition, and remember, they've already done the $250 million of non-competitive bids. That's not in this list. So they've already accepted those. But in addition to the non-competitive bids, they've received $200 million worth of competitive bids with a 4.9% coupon. They also received $250 million of competitive bids with a 5.05% coupon. They got $250 million of competitive bids at 5.12. And then lastly, they also got another $250 million of competitive bids at 5.2. Now, of course, the government does not want to do the 5.2. They don't even want to do the 5.05. They don't want to do it, but they have to because they fell short. They need to raise an additional $750 million. So what are they going to do? So the Treasury here will accept $200 million of bids at the 4.9% interest rate, which is, if you think about it, probably lower than what they were expecting to pay anyway, because we originally said that the interest rates were right around 5%. So if interest rates were 5 and somebody came in and bid, now they were kind of shooting themselves in the foot. They were underbidding, but they underbid to 4.9. So the government's like, yeah, we'll take those. So they're going to take those $200 million of bids, but they're also going to take the $250 million of those bids at 5.05. Now, they didn't want to here because the interest rate was higher than what they may have expected, but they had to because, remember, they had originally sold only $250 million of the $1 billion, so they had $750 million to go, and right now they had to take the $200 million, so 250 plus 2 is 450, and then they're going to have to take the 250 here because they're still a long ways from their $1 billion goal, so they're going to take the 250 million more at 5.05%. So if we add that all up for the moment, between the three groups of people that the Treasury has accepted their bids, the total is now $700 million. But that's $700 million out of $1 billion goal. So the government or the Treasury is still short by $250 million. So, I'm sorry, $300 million. So they need to raise an additional $300 million. The problem is that the only other bidders left had higher interest rates, but the Treasury has no choice. So next, the Treasury will accept $200 million. The next group of people were $200 million at 5.12%. Now, of course, the government is, or the Treasury is short by 300 million, so they're going to have to take these 200 million at 5.12. So they're going to accept those bids as well at 5.12. So now we're at 900 million. We're almost to the goal, but we're still 100 million short. So the Treasury will accept the 200 million at 5.12. We're now at 900 million. That means the last thing the Treasury is going to do is take that final 100 million. And remember, that final group of people are actually $250 million. It was $250 million of bids at 5.2%. But the government doesn't need 250 million more. They only need 100 million more. So they're going to accept 100 million at 5.2%. That takes the total now to $1 billion. So once the government or the Treasury has reached its goal, the Treasury, or the auction rather, is now over. There's no more bidding. There's no more accepting of bids, non-competitive bids, competitive bids. Nothing else goes on. The government has reached its goal of $1 billion. The auction is now over and everybody goes home. Now, the problem here in the real world is it fair? Because if you think about it, some people had interest rates that were different than others. Some people had interest rates of 4.9. The non-competitive bidders didn't really even know what the interest rate was. They're kind of at the mercy of everything. Then there were some people who got in at 5.05, some got in at 5.12, and others that got in at 5.2. Well, how does the government keep track of it? Is it fair that everybody gets their own individual interest rate? Well, some people would argue it is fair because they made that bid at that price or at that coupon. The Treasury doesn't do it that way. So what they do is at the conclusion of the auction, all investors, all $1 billion worth of investors, receive the same yield at the highest yield accepted. Now remember, in the example we had, the highest yield that was accepted was 5.2%. So what's happened here in this auction is, even though some people put in a bid lower than the 5.2, because the government accepted some bids at 5.2, everybody gets the highest bid. Now in the bond market, we call this the stop price. Now we call it the stop price because this is the price at which the bond auction was stopped. So once we got to the billion, that the interest rate on that last $100 million of bond issuance was 5.2. Once they accepted 100 million of that, the auction had stopped. This now becomes the stop price. So the stop price is the coupon on the bond that all of the investors who issued or who made a bid for this bond are going to get. So I put down there at the bottom, in other words, the Treasury in this example auctioned $1 billion with the stop price, or if you want to call it a coupon of 5.2%. Pretty simple. So the stop price is the price at which they stop the auction because the auction is now over because they've raised all the money they're going to raise or they wanted to raise, right? Now, let's do a little primer on bonds, how they work. So for an investor, and I'm just going to do this on an individual basis because it's easier to understand that way, but for investors, a 5.2% coupon means that for every $1,000 invested, and remember, in bonds, we generally call that par. Bonds have what we call par value, and par is $1,000. So if you bought a bond from the Treasury, you give the Treasury $1,000. They give you whatever the coupon is, in this case, 5.2%. And that means, by the way, that somebody's going to receive 5.2% of $1,000. So 5.2% of $1,000 is $52 a year. So this bond is going to pay $52 a year in interest payments. Now, this bond investor is not going to get their principal back until the end of the 30 years. So this is an interest-only bond. There's no interest or no principal payments on this bond at all. You get those at the end of the maturity. In this case, it's not going to be for 30 years. So you'll just simply get your $52 a year. Now, the government doesn't make one payment of $52. They actually do semi-annual payments. So you'll get two payments totaling 26. That's half of 52 is 26. So somebody's going to get $26 every 6 months for the next 30 years in interest payments. Now, I get people asking all the time, when do the payments come out? They usually come, well, they're not usually, they come out on the first of the month. And how, what months do they pay those? Well, it depends on when you bought the bond. So we have just a little system we use in the bond market where we say, if you bought a bond in November, which in this example I'm going to give you what we did, and the real life example I'm going to show you at the end here was actually the November 9th auction. So that would be a November bond. So 6 months later, in the future is when that person is going to receive their first payment of $26. So in May of 2024, somebody's going to get a $26 payment from the Treasury for the bond that they bought on October 9th, right? And that's going to happen. And we call that, by the way, an N and M bond. And the reason we call it N and M because N for November, M is in May. So we have a lot of different examples of this. For example, you can have a J&J bond, which is January and July. We have an F&A bond, February and August, M&S bond, March and September. So every 6 months, we just use the first letter of the month of that month to tell us what kind of bond this is. So this would be an example of what we would call an N and M bond. They get their monthly, their semi-annual payments rather, every in the future for the next 30 years, every November, every March, or I'm sorry, every May. All right, so for the next 30 years. Once the debt matures, at the end of 30 years, the Treasury will make one last payment of $26 plus give back the $1 billion they borrowed. So now they're going to pay back the principal amount of money that they borrowed from everybody on this bond. Now, this is where the government makes out like a bandit. And this is why I'm not a big fan of bonds, especially really long bonds. The reason for that is because of inflation and the devaluing of the currency that goes on with our government, $1 billion in 30 years, or the $1 billion today that somebody paid for a bond, is only going to be worth maybe 600 million in real terms 30 years from now. So, and again, that's one of the big drawbacks of bonds. They don't keep pace with inflation. So yeah, you're going to get your $1,000 back at the end of the year, or at the end of 30 years in this example, and it's going to have on the face value of it, it's going to be $1 billion. But that $1 billion is only going to have the buying power of 600 million because of inflation and all kinds of other things. So now some people say, well, you made it up in the interest rate you got on the bond. Well, you got 5.2%. Over 30 years, $52 a year comes to what? And I'm doing this in my head, about almost $1,600, $1,560, I think it is. So it's $1,560 in interest payments you've gotten over the last 30 years, but you lost $300,000 or $400,000 in principal. To me, that's not a really good deal. I mean, you don't have to be a rocket scientist to know that, trading $1,500 in interest payments for a loss of $300,000 of buying power over 30 years is not really a good idea, but people do it. But once the debt matures, everybody gets their $1,000 back, plus that last payment of $26, and everybody's happy, so to speak. Now, in this example, this would be considered a bad auction, as the Treasury had to issue $1 billion of new debt at a higher yield than anticipated. They were expecting the interest rate to be at 5 or right around 5, but it ended up being at 5.2. So the rate ended up being higher. So, and of course, whenever the rates are higher, that makes future interest payments higher as well. So the Treasury is not going to be happy about this. We're going to consider this a failed auction. Now, can we tell how bad this auction was in any kind of quantitative terms? We know this was a bad auction. We know that the interest rate went higher because there weren't as many bidders as everybody was hoping there would be. And there weren't as many more bidders at lower interest rates. We only had a few people bidding. Some people bid at 4.9, but others the others were bidding at like 5.05, 5.12, 5.2. So the Treasury was kind of hoping that some other people might come in at 5.01 or 5.02 or something kind of smaller so they didn't have to go up that high. But in this case, that didn't happen. So the Treasury kind of considers this a failed auction. They still issued the bonds. They still issued the debt because they needed the money, because Ukraine needs that money. So, and Joe Biden promised it. So they went ahead and did it, but they did it at a higher interest rate than they expected to. Now, how do we calculate, or how do we look at to find out, or what measurement can we look at to determine if this was really kind of a really bad auction or is it just kind of mediocre, middle of the road type of auction? Well, there's another thing we look at. We call it the bid to cover ratio. This is one of those financial terms that literally means what it sounds like. How many bids did it take to cover the debt that was issued? So, and we'll do that math here real quick because it's really simple. But we do use a bid to cover ratio to measure an issuance success or failure. So the bid to cover ratio is one of those important things. Whenever I hear the guy on CNBC who does that is a guy named Rick Santelli. He does it, when the bond auctions happen at 1 o'clock. He usually does the break-in on the news and says, breaking news: the government just issued X number of bonds, 30-year bonds, 10-year bonds, whatever they were, and he'll tell us what the bid to cover ratio is. That's one of those things I'm always listening for. I want to know what the bid to cover ratio is. The higher the bid to cover ratio, the better it is. That means that it was a much more successful auction. Low bid to cover ratios are bad. We don't want to see low ratios. But we want to see ratios that are kind of in context with other previous ratios. Now, we don't necessarily say, let's say a bid to cover ratio comes in at say 2.5. Do we say that that's a good one or a bad one? Well, we just compare it to the previous history. Say, well, what is the average bid to cover ratio for a 30-year bond? Well, I can tell you right now, right off the top of my head, that's 2.4. So the normal bid to cover ratio is 2.4 on a 30-year bond. So if a bid to cover ratio is less than 2.4, that's bad. That's kind of bad. We don't want to see that. We want to see a number greater than 2.4. That means that there were a lot of bidders. So a bid to cover ratio that's a lower number means fewer bidders, and fewer bidders means higher interest rates. So the bid to cover ratio is simply a ratio of bids received divided by the amount of bonds sold at auction. Now, in our example, the Treasury received a total of $1.2 billion in bids. That was all those numbers we had. We had the $250 million of non-competitive bids. We had $200 million of, and I'm not going to go through all those. I'm not looking at that screen. But we had, 4 or 5 other bids. We had one at 4.9. We had one at 5.05, I think it was, 5.12, and 5.2. So when we add those all up, it came out to 1.2 billion. In this example, it took $1.2 billion in bids to raise $1 billion. So we simply divide 1.2 billion by 1 billion. Well, that comes out to 1.2. That's a horrendous bid to cover ratio. So we would consider that, in all honesty, in the real world. And I just made this up, by the way. So I'm not saying that's what happened last Thursday or anything. But if we saw a bid to cover ratio of 1.2, it's time to head for your bomb shelters type of thing. That's how disastrous that would be. But the lower the number, and of course the number gets below 1 means that the Fed couldn't raise up enough money. And we've never really seen that before, where the Fed couldn't raise enough money. Even during wartime, World War II and stuff, the Fed or the Treasury was always able to raise enough money to cover the cost of buying, building weapons and guns and planes and trains, all this stuff for war. But if the bid to cover ratio falls below 1, it's a disaster. It simply means the auction was not only was it a bad one, it didn't even raise the money. Maybe they're trying to raise $1 billion and maybe they only raised 800 million. They're 200 million short, and there's no other bidders. Now the government's going to take the 800 million. They're going to be like, oh, that's all we've got, but that's going to scare the bejesus out of anybody, because now the Treasury's thinking, well, if nobody bought the full issuance on that previous, why would we think they're going to buy any others? Now we start thinking that nobody wants the treasuries anymore at all. And now the government is bankrupt. So the bid to cover ratio is a very important number. The higher, the better. Lower is dangerous. Now, from a previous 30-year auctions in 2023, we know that the average bid to cover ratio is 2.4. So a 1.2 bid to cover ratio would be considered disastrous. It means there's extremely low demand. Now, of course, I just made this up. I didn't make up the 2.4, that's the real number. But the 1.2, that was just numbers I made up, just to give you an illustration of how it works. But we want to see numbers close to 2.4 when it comes to the bid to cover ratio. Anything less than 2.4 is going to be considered dangerous and a bad auction. A bid to cover ratio below 1, of course, would be considered a failed auction and catastrophic to the U.S. government because they couldn't raise enough money to fund their operations. Now, remember, earlier it was stated that institutional investors had access to the auction before the non-competitive bidders. So we call that the when-issued market. So where competitive bidders can bid prior to the auction. Now, some people think it's not fair that they get that advantage where they can bid prior to the actual auction, but it's actually part of the market discovery or the price discovery process for the bond market. And so the Fed and the Treasury likes this. So this is actually good for the market because it helps us to figure out what the price for money ought to be. That's what interest rates are, by the way, just the price for money. So the early bidding helps create a price called the snap price. Now in finance, just to kind of go through the snap price, because we've already, don't confuse this, by the way, with the stop price. But in finance, the snap price, snaps simply means what's the price right now. It's not what is it a month from now, 2 months from now, a week from now, an hour from now. It's what's the price right now. We commonly see this or do this in the commodities markets where we talk about oil or gold or something. The price of oil, you might, if you want to buy a barrel of oil right now, it's going to cost you in the snap price. I looked at it just a little while ago. The snap price for oil is $78.06. So if you want to buy a barrel of oil, you're going to pay $78.06 for that barrel of oil. Now, is that price going to last very long? No, the market's constantly moving. I just know that if I bought it right now, 78.06. If I buy an hour later, it could be higher than 78.06. It could be lower than 78.06. It could still be 78.06. That just simply means there's no real supply demand issues in the market. And it could be also because it's the weekend and that market got to close type of thing. So at the end of the day, on Monday morning, I come in and the price of oil is going to be different than 78.06. So that would tell me what the snap price of the oil market or the oil barrel of oil is at that time. So snap just simply means what's the price right now. Now, what does that have to do with this auction market? The early bidders are trying to figure out price discovery. They're trying to figure out what is the interest rate going to be on this 30-year bond. Now, we kind of feel like, and remember in the example I gave, we said interest rates were right around 5% on a 30-year bond. So if I'm a bond investor, I assume the interest rate is going to be somewhere in that 5% range. It could be higher, could be lower though. But sometimes, especially if I'm a big-time investor and I'm holding $20 billion worth of assets to buy bonds, I want a better idea of where those interest rates are. Are they at 4.8? Are they at 4.9? Because I might not be interested in 4.8 or 4.9. In fact, if interest rates were around 5, I'm probably not interested in 4.8 or 4.9. So I'd say, you know what? I'm going to find something else to invest in for my clients. On the other hand, it could be at 5.1. In that example, I might say, well, yeah, hey, we're expecting 5%. We're going to get an extra 0.1%. Not a bad deal. So maybe we go all in on it. So it helps us to discover what the price is at that moment. Now remember, it doesn't have anything to do with where the actual price is. Remember, that's the stop price. It just tells me where the price is right now. It could change, could go higher, could go lower, could stay the same. I never know. But for the moment, kind of gives me an idea before the auction starts. So early bidding helps create a snap price that sets the expectations for the auction. And it is a very important piece of data to investors to gauge interest in the debt issuance. So let me put this in simpler terms. The snap price is just the expected price of the issue. The actual price or the stop price can be higher or lower based on demand for the issuance. So snap and stop. Snap price is where it's at right now before the auction happens. It's the expected price. The actual price, though, is called the stop price. Once the auction stops, the stop price tells us where interest rates were at that moment. So snap price, stop price. Don't confuse the two. Now, this is logical. Now, of course, I'm an economist. It sounds logical to me, but may not to you, but it should. In overbidding, there were a lot more bids that came in than were expected. So instead of, in the example I gave earlier, I said maybe somebody did, the competitive bidders did $1.2 billion of bids. Well, sometimes it comes in $5.5 billion. The government's only trying to raise $1 billion, but $5 billion of bids comes in. What is that going to do to interest rates? What's that going to do to the snap price and the stop price? Well, if something is overbid, the stop price, final price, the coupon on the final price, is going to be lower than the snap price. So when everybody, the day before, when the institutional investors are thinking about this bond and they're looking at the interest, there's, at that point, there's not that many people that have actually placed a bid. And then when the auction actually happens at 1 o'clock the following day, there were so many bids that came in, the interest rate fell like a rock. Well, that would be logical. So in that instance, the stop price would be lower than the snap price. They simply didn't know. Now, of course, investors don't like that. They don't like overbidding. They like underbidding. But of course, the Treasury looks at it differently. The Treasury loves overbidding. The Treasury can get interest rates that are lower than what were expected. So the Treasury loves to see, or the government loves to see, overbidding on these auctions. But if you're an investor, you want as high an interest rate as you can get. That requires underbidding. So the underbidding down there in the second paragraph is the exact opposite. So the inverse is also true. In underbidding, when there's fewer bids, the stop price would be higher than the snap price and indicates a weak auction, lower demand. And again, the only time the stop price would be higher than the snap price is because there just weren't that many people came into the auction. The auction, people just said, yeah, maybe it was raining that day and they didn't want to get out in the rain. Now, these are done online and stuff, so it's not really that way. But still, you understand. If there's not as many people interested in that auction, there's not going to be as many bidders. And if there's not as many bidders, of course, the price for that or the interest rate on that issuance has to come down. Or, I'm sorry, rather go up. Right? So to put these ideas into perspective, the snap price tells investors how the issue traded before the auction, while the stop price reflects the strength during the auction. And ultimately, the stop price becomes the price at the end of the auction, once the auction has concluded. Once the government has raised up all the money they want to do, whatever interest rate is on that last final acceptance of those bids, that's the interest rate it's going to be on this debt. This leads to one last idea. So thankfully, we're almost done here, guys. So it leads to one last idea, what's something called the auction tail. Now, again, the auction tail is one of those things that's actually very important as well. So to me, it's just as important as the bid to cover ratio. So the auction tail tells me whether the auction was successful or a disaster. So the auction tail is simply, and again, it's nothing, it's third grade math. It's something even a politician could do. The auction tail is simply the difference between the stop price, which remember that's the high yield, and the snap price or the when issued price. So whenever we know those two numbers, we just simply subtract them. If the number is negative, we would call that a negative tail. If the number is positive, we'd call that a positive tail. If it's neutral, we have a different name for it. So let's kind of go through this. If there's little to no difference in the yields between the snap and the stop, the issue is said to finish on the screws. In other words, it came in right about where everybody thought it was going to be. So let me give you a quick example. So let's say 30-year treasuries right now are trading it with a 5% coupon. And the government issues another $1 billion of 30-year treasuries. And the interest rate comes in at 4.99. Well, that's close enough. So there's very little difference. There's only 0.01 difference between the snap and the stop. So this trade or this auction is said to finish on the screws. I have no idea where that phrase comes from, by the way, on the screws, but that's the term that's used in the market. It has been for decades. So that's the term that's used. So whenever you hear, if you hear Rick Santelli talking about on the screws, just simply means everything went pretty much the way it was expected to go. Now, on the other hand, sometimes you end up with a negative tail. So a negative tail is when the stop price, remember that's the final price, interest rate, is lower than the snap price. So what does that tell you? Well, that means that there's a bigger demand. So the final interest rate is lower than the original interest rate because a lot of bidders came in. So in this example, and this is something the Treasury is hoping to happen. So in this example, let's go back to our original example about the 5%. So let's say the Treasury issues $1 billion at 30 of 30-year Treasuries, 30-year bonds, and the 30 years are currently trading right around 5. But because there were so many people interested in this auction, interest rates actually, the stop price was actually, instead of being, the snap price on this would have been right around 5, by the way, just to kind of go back to it. But the stop price might have been 4.9 or even 4.85 or 4.8, who knows, depending on how many bidders there were. So there could have been so many bids that the snap price was like, holy cow, that was way off. Now, of course, that's going to make the investors angry. They don't want to see that kind of stuff, but that's the risk they take in making these bids. So if the snap price if the stop price is lower than the snap price, that means there were a lot of bidders. Interest rates went down. Investors are not happy because they ended up getting a 30-year Treasury at a lower rate than they were expecting. They were expecting 5, and maybe they got 4.8. Now, in the scheme of things, is 5 versus 4.8 different? Well, it's $2 a year in interest. $48 a year in interest versus $50 a year in interest. So it's $2 a year. Now, is it going to break the bank? Probably not. But if you're a big time investor and every dime counts, if you're buying billions of dollars of these things, that could be some real money. There's a real difference in what you expected the income for your clients to be versus what the client income is going to be. So a negative tail is kind of bad to the investor, but good to the Treasury. Well, the opposite is also true. Now, a positive tail is the inverse of the negative tail. So a positive tail is when the stop price is higher than the snap price, forcing rates higher due to lower demand for the issue. Now, again, this is something the Treasury is not hoping it happens, whereas the investors are, because the investor is going to end up with a higher interest rate than what they expected. So if the snap price was 5 and the actual stop price was 5.2, well, man, you got 2/10 more. You're making $52 a year in income on the bond versus where you thought you were only going to make, say, $50 a year. So you're making $2 a year extra, more over and above what you thought. So investors love to see that, whereas the Treasury does not, because it drives up interest rates. And whenever you drive up interest rates for the Treasury, that means interest payments are going up, which means taxes either have to go up or more borrowing has to ensue. That's why we call this a debt spiral, by the way. As interest rates go higher, the government has to borrow more money just to pay the interest because the interest rates are increasing. So at the end of the day, the government does not want to see a positive tail. Now, positive tails, we do have those from time to time where the tail was positive, but in general, we don't want to see positive tails greater than, say, 2, maybe 3. So in general, the general rule of thumb in history historically is if you have a positive tail on a debt auction and that positive tail is, let's say a 4, a 5, or even a 6, God forbid, that means that bad things are really happening. So the Treasury is hoping, if it is a positive tail, that it's still going to be a positive tail of only, let's say, 1 or 2. We don't want to see a big difference between the stop and the snap when it comes to that. So a 2, again, would be considered tough, but nobody's going to go home, and be scared about what's going on. But when you see tails of 3, and especially 4 and 5 and 6, that's when people wake up and it spooks the market and bad things start to happen. So remember the rule: the larger the tail here, and this is a positive tail, not the negative tail. The larger the tail, the worse the Treasury auction was. A tail greater than 4 basis points is considered disastrous. We don't want to see anything greater than 4. It just simply means it's unheard of. And by the way, we don't, historically in this country, we don't see tails 4s and 5s. I'm not saying it's never happened. I've never gone back through the entire history of the nation to find out what the average tail is from time to time, or what the highest tail has been, or that type of thing. So, but we don't, we're the reserve currency of the world, largest economy in the world by far. We don't expect to see tails of 2s and 3s and 4s, and especially 4s and 5s and 6s. So I gave you a primer on how the Fed, or how the Treasury rather, raises money to operate, keep fat old Uncle Sam fat and stupid. So why is this important? And what is this all about? So let's go back to what happened on Thursday, October 9th. So on October 9th, the Treasury rather, issued or wanted to issue 30-year bonds. Now they were issuing 112 billion. So I don't remember. I did look to see what those bonds were being issued for. Part of it was for Ukraine. Part of it was going to Israel as well. There was some other stuff going in there for salaries for some military people and pay raises for congressional aides and stuff. So there was some fluff in there. I'm not saying the salaries for military was fluff. I actually think they would deserve it more than congressional aides because at the end of the day, congressional aides are unelected, unappointed people. They're just we don't need to pay them more. We need to pay them less, make them go out and get real jobs. But at the end of the day, they raised 100. They were trying to raise 112 billion dollars of bonds in a 30-year market. So let's look at what actually happened. Now, the interest rate in the 30-year bond market prior to this, so um, in the snap market, if you will, the interest rate was right around 3.7. So at that moment, the interest rate on a 30-year bond was trading right around 3.7. It might have been 3.71, 3.72, back down to maybe 3.69, but it was kind of in that ballpark. Bonds don't change that much on interest rates unless something drastic has happened. But they were trading at that time at about 3.7. So let's look at what happened on Thursday, October 9th, 2023. So the Treasury auctioned $112 billion in 30-year bonds. I just told you that. The snap price, as I said, was 4.71%. The stop price, and this shocked everybody, the stop price was actually 4.77. Now, it doesn't look like that was a big difference. That's about 6 basis points difference. But in a 30-year bond market, 6 basis points is huge. Normally, bonds trade in the decimals of basis points. There may be half a point or a quarter of a point type of thing. They don't trade in 6 basis points at a time. That's huge. So that was a drastic move up, and it startled the stock market. The stock market actually started tanking. Some of the guys and I were watching the market at the time, and we were like, "What's going on here?" Because we see the market tanking like crazy. And what was going on now? I don't follow the bond market. I wait for Rick Santelli to come out at 1 o'clock to tell me what happened in the bond market. But the market was already reacting to what was going on here before I knew it. That's why this business can be dangerous at times, where we get into a trade and the bond market fails or bond market issuance kind of goes flat and the market takes on the news. We can fix those things, by the way. We're kind of nimble enough to get in and get out and handle that. But if you're a long-term investor, there was nothing you could do. Especially if you were doing your own job and you woke up the next day and found out your stock tanked overnight. But the stop price was 4.779. The auction tail, was a positive 5.3, largest tail on record. We've never seen it before, not in the United States of America. A 5.3% tail or 5.3 tail, it's not a percent, but it's just a tail, is ungodly. It was disastrous. It was stuff of lore. It was the stuff that, economists thought, deep in the bowels of some building somewhere saying, hey, what would happen if a positive tail was 4 points or 5 points or something? People are like, oh, that will never happen. You're talking fantasy land. It happened. A 5.3 tail, largest tail on record. The bid to cover, 2.24. Now, earlier I told you that the average bid to cover for a 30-year bond in the United States, 2.4. Actually, I'm sorry, 2.5. So we're roughly 25 basis points below the average. That tells me buyers of 30-year bonds are drying up. They dried up so much, the difference between the snap and the bid or the stop was 5.3 points. That's just an amazing number. And it's scary. Now, we talk about why does this happen? Actually, before I do that, let's do the last bullet point here. The auction was so bad that the 30-year bonds themselves spiked 12 basis points to 4.87. So about 5 minutes, I told you the market started tanking. The reason the market started tanking is because everybody was like, well, wait a minute, what? Why are people not buying our 30-year treasuries? Why did the government struggle, the treasury struggle so much in getting people to buy these treasuries? And that's the question that has to be answered. So the auction was so bad, interest rates went up. So they spiked to 4.87 immediately right after this. So they went to the 4.77 and then kept going, the regular interest rates. When interest rates are going up, that means bad things are happening in the economy. People are like, what's going on? It's scary. Of course, when interest rates go up that much, that fast, the stock market's going to crash. And it did. It went down immediately on that particular day. Now, later on, it recovered. Interest rates came right back down. Now, I don't know necessarily why, other than a little bit of maybe greed in the marketplace, where some bond investors, because they saw the price of their bonds spike momentarily. Remember when interest rates, came down. When interest rates go up, bond prices come down. So maybe some people kind of, when that spike, were like, oh, I'm getting out of this because it looks like it's going to keep going down. So they kind of fell for a head fake type thing, and they may have bailed the position. That could explain some of it. Some of it could be just, it was an immediate thing, and people started to say, hey, it's not that bad. It's kind of bad, but it's not the end of the world type of thing. So maybe cooler heads prevailed. But as an economist, what it does is it kind of tells me that there's a problem here. And the problem is that buyers for 30-year treasuries are drying up. The last couple of auctions, we've seen the bid to cover ratio well below the 2.4, 2.5 norm. We've seen 2.28, we've seen 2.27s. This was a 2.24. Now, we already know that China is not, has already said they're not going to be buying any more of our bonds, or they're reducing the number of their bonds they buy. Now, a lot of people ask, well, why does China buy bonds from us anyway? Because we're kind of the enemy to them. But at the end of the day, remember, American people buy so much junk from China, especially from Walmart and stuff, that China is flush with cash. They've got to do something with that cash. Well, one of the safest places to put that cash is in the U.S. Treasury market. But China's starting to ramp up. Ever since Joe Biden's been president and stuff, China's been, saber rattling a little bit. They want to invade Taiwan so badly it hurts them. But they want to do stuff, but they don't necessarily want to tick us off. They can't beat us in a war. We can't necessarily beat them in a war either. They got as many nuclear weapons as we do. So they have to figure out a different way to beat us without firing any shots. And one of the ways to beat us is to stop buying our bonds. They're the largest buyer of our bonds. And if they stop buying our bonds, or even if they just slow down the rate at which they buy our bonds, bad things are going to happen to the economy because interest rates are going to have to keep going up. Remember, China's buying a massive number of bonds. So when it comes to the overbidding, they have a tendency to, buy so many bonds that a lot of those bonds become overbid, where interest rates start trending down. But if China comes out and says, we're not going to buy those bonds anymore, whether, completely none at all, or if we're just going to reduce it by half or 25% or whatever it is, if they start reducing the number of bonds that they buy, interest rates are going to start creeping back up. And interest rates get to the point where we're already seeing that the third largest expense to the federal government this year is interest on the debt. It's at about $850 billion. That's more than defense, by the way. Defense has always been the second biggest expense in the government's budget because we spend a lot of money on our military, guns and planes and weapons and ships and submarines and all the stuff that we buy. But now it's the national debt that's the second largest. It's the second largest. And I'm counting transfer payments, which is Social Security and Medicare and Medicaid and all that stuff as one. Technically, Social Security and Medicare are all different things, but if you kind of combine them into one and call them transfer payments, that's the biggest expense, and then it's national debt and then defense. Or interest on the national debt. If China continues to reduce the number of bonds they buy, Japan is also, by the way, they're not doing it for the same reason. They're doing it to try to. They're working on trying to save their own currency because they've made some huge mistakes over the last 20 years in their own bond market. So they're trying to fix those and keep the yen at a stable level. And to do that, they have to cut back on the number of bonds that they buy from the United States. They're actually selling some bonds. So as these governments continue to not buy our bonds, interest rates are going to start creeping up because the biggest buyers of the bonds, of course, the Chinese by far. But as interest rates go up, um, other things start to happen. The interest on the debt goes up, things get worse, our deficits get bigger. And what happens here is we get to the point where we get into a debt spiral. Interest rates start creeping up, which means the interest on the debt goes up, which means all future debt has to be, or all new bonds that are issued are issued with higher interest rates even still. So the interest rate may have jumped to from 4.71 to 4.77, and then out of fear it went to 4.87. Now it did come back, but let's take this further. Let's kind of keep this going, this little scenario here. Let's say they do another bond issuance, and again, there's not as many buyers because the Chinese are sitting it out, the Japanese are sitting it out, and the British are sitting it out, or maybe not buying as many. So there's not as many people buying them. So interest rates are going to go to say 4.9, maybe back to 5. Now the interest on, and remember, if the federal government issues that debt at 5%, we know that the federal interest payments are going higher. They're higher than what they were. And then now to pay those off, because remember, they got to pay, if it's at 5% now, they owe somebody $50 a year. To pay that $50 a year, they're going to have to raise more debt. To raise more debt, there's fewer buyers. Now the interest rate is going to be 5.2. And now somebody's getting $52 a year instead of $50 a year. And to pay that extra $2 a year, they need to raise more debt. To raise more debt, now they're going to have to issue a bond at a 5.4 or 5.5% interest rate, and then a 6% interest rate, and then a 7. And that's why we call this a debt spiral. It gets to the point where you have to keep raising the interest rates keep going up because the demand for the bonds becomes slower or lower and lower. And as the bond demand becomes so low, eventually nobody wants our bonds anymore because they're not worth the paper they're written on or printed on. So at the end of the day, that's the kind of thing we're starting to face. And that's why I said in one of our meetings a couple of weeks ago, are we at the beginnings of a debt spiral? I think we finally are. We've kind of been waiting, as economists, we've kind of been waiting for this. We know it's coming. Strange thing happened 2 days afterwards. By the way, it had nothing to do with the actual bond issuance on Thursday the 9th or whatever that was. A couple of days later, or it actually may have been the Monday following that, the Congressional Budget Office, known as the CBO, and by the way, these are not conservative economists. These are Democrat economists. We call them Keynesians. They love debt. You can always tell a Keynesian economist when you ask them a question about our national debt, and they say, "Oh, don't worry about it. We just owe it to ourselves." If you hear somebody say something like that, you know they're a Keynesian, which means that they're frankly out of their minds. Because it doesn't matter whether we owe it to ourselves or not, you still owe it. And it's got to be paid back. Whether it's paid back to your grandma and grandpa in a nursing home, it doesn't matter. It's got to be paid back. It's an obligation under law. So these guys kind of imply, well, don't worry about it because you don't have to pay it back. But not in our lifetimes. It doesn't work that way. The bonds have to be paid back. Now, you can bankrupt on them, but legally, the United States government cannot bankrupt on its debt obligations. So that's kind of murky law there, where, can the federal government eventually bankrupt? Eventually, they're going to anyway. And that's where I was going to with the CBO. The CBO came out on Monday, the following Monday, excuse me again, came out the following Monday and said that the government, the United States government, has about 20 years left to figure this out. In 20 years, the debt load is going to be so high, interest rates are going to be so high, there's not enough money in the government budget, money coming in to cover anything other than the debt repayments. No Social Security, no Medicare, no Medicaid, no national defense, no government salaries, no pensions. None of that stuff's going to be available because almost every dime coming into the government is going to go to debt maintenance. So we got about 20 years to go. That's what's scary about this, guys. At the end of the day, 20 years isn't that far. Now, I'll be, I'm in my 60s now, so I'll be in my 80s in 20 years if I'm still alive. Some of you are in your 30s and 40s. You're going to be looking to Social Security about that time, and it's not going to be there. In fact, nothing's going to be there. So I'm not doing this or saying this to scare anybody because we do have some time to try to fix this. But I think it's probably too late personally because the American people have been so sheltered. We've been dumbed down by the public school system for so long, and we kind of still believe that, when a politician says, "Oh, we're going to fix it, we're going to fix it, we're going to fix it," people still believe. They still believe that Joe Biden, 30% of American people still believe Joe Biden's doing a good job. Um, I personally, I don't understand how they think that way, but at the end of the day, people are, we all have different views on different things. But at the end of the day, we've got about 20 years left before this thing comes tumbling down. What are we going to do? I've had some people ask me, what do we do if and when that time comes? As we get closer and closer, of course, we got time still before anything happens. I'm not saying panic, but what happens when this happens, if it does happen? We have a really good history of a lot of nations that have gone through this. It's basically what the government has to do is monetize the debt at that point. Monetizing the debt is disastrous. The biggest country or economy that ever tried it was Germany right after World War One. Everybody blamed Germany for World War One. That's a political issue. I'm not going to get into that. But whether Germany was actually responsible, the French and the British really wanted to punish the Germans, and they did. They basically took their gold. Well, back then, our money supply was based on gold. And if you take a nation's gold, you've basically taken their ability to print money because back then you could only print the amount of money you had in gold reserves. So if you had $1 billion in gold, you could have $1 billion of currency in your economy. Well, France and England took that gold as reparations for the war. So they had very little gold left. Now they were trying to mine for some more gold, so try to develop their economy and start printing money again. But at some point they were like, well, we don't have any gold left, so let's just go ahead and print. And that's called monetizing the debt. So they just started printing. At the time it was called Deutschmarks. They started printing Deutschmarks. And a funny story from that time, there was a woman who had gotten sick. She had actually fallen in. She was visiting her sister in Switzerland or Sweden or somewhere, and she had left. She had left Germany in 1920 or 1919 or something, and had about $100,000 of in today's money, $100,000 to live on for the rest of her life. And she was in her 60s or something. So she had plenty of money from her husband. Her husband had died in the war. So she had plenty of money to live off of his income and stuff. And she ended up getting sick when she visited her sister in Sweden or Switzerland or wherever it was. And then just before she was being released from the hospital, she had a cough and they found pneumonia and some other things happened. So she ended up being in the hospital for quite some time. So it was about a year later that she was finally released from the hospital. Because remember, this is the 1919s, 1920s. Medical stuff is not that good then. But they finally released her. She goes home. She's going through her mail. Something catches her eye. And the thing that caught her eye is in the upper right-hand corner of the letter that had been mailed to her from her bank was the stamp on that letter. The stamp cost 2.4 billion marks. Now, this woman had like 100,000 marks in her bank account, which was plenty of money prior to this monetization of the debt. But once the monetization happened, she didn't have enough money in her bank account, her savings account, checking account, to cover the cost of the stamp that they put on the letter to send to her to let her know that she was broke. That's what happens in monetization. That's what's going to happen here. So is it going to happen in the next 20 years? I don't know. Is it going to happen in the next 30 years? Probably. There's a really good chance because Congress and the Senate, they're never going to get their act together. They're never going to agree on cutting spending and stuff. It's just not going to happen until there's an emergency. So at some point, it is going to happen to us, and we're going to monetize the debt. And once we do, we're going to go down the same route that Germany did in the early 1920s. To stave that off, so some people say, is there anything we can do? Before that happens, we're going to move. We'd have to move. And by the way, cash is going to become worthless. It happened to her in Germany in 1920s. So you can't come back and say, well, I'm going to take all my money out of my IRAs and 401ks, put it in Chase Manhattan Bank and stuff. That ain't going to work because once they devalue the currency is devalued. So your money becomes worthless. And some people say, well, I'll put it in real estate. Well, real estate, it's all based on money. So if nobody can afford to buy your house and the house is only worth what, the next buyer is willing to pay for it. So if you got $1 million house, that house might be selling for 25,000 or less. Now, of course, I'm giving exaggerated examples, but that's the kind of stuff that can happen. So what do? Well, historically, people run to gold. But remember, in the 1930s, FDR, when he was president, he put some limits on the value of gold too. So, and he put some limits on who can own it. We actually talked about that in one of our meetings previously. So, you can't count on gold in the future. What else can we do? Those are the questions that people like me have to kind of think about. I'm actually leaning towards Bitcoin now at this point. Now, I've kind of written Bitcoin off. I sold my Bitcoin a couple of years ago after a wise man told me it was time to sell. And he was right. I sold it pretty much to high. But at the end of the day, it might be that, in the future, we might be starting to think about getting back into Bitcoin or converting some assets into Bitcoin so that we can trade or keep growing our money and not have to be subject to all this stupid stuff that's going on around the world. By the way, there's no safe place around the world. The Europeans are doing everything we're doing. Japan, by the way, has a GDP, a 250% GDP to debt ratio, which is completely unsustainable. So they're in the same boat. So it's not like, it's just us. China's in the same boat too, and theirs is actually a little bit worse because their real estate issues are horrendous right now. Their economy has actually gone down by $3 trillion in the last 3 years. Our economy is at about 20 trillion, give or take. Um, China a few years ago was at 13 trillion, and now they're back down to 10, $11 trillion in size. So their economy is actually contracting a lot simply because they're doing a lot of stupid things. But at the end of the day, there are some things we can do to try to get around all this stuff. But one of the things we have to do is just start thinking about what's going to happen in the future. And it might be Bitcoin, it might be something else, but not going to be able to hold cash. You're not going to be able to hold real estate. Those things are going to become effectively worthless if they have to monetize the debt. And again, the CBO says we got 20 years. CBO is notoriously wrong in every projection they make. They came out and said that Joe Biden's budget was going to only increase the deficit. So I think their original estimate was to 1.2 trillion. Here it is at 2 trillion. So they were off by $800 billion. Sounds like a little loss, but or a little difference, but that's a lot of money to be off by. These are trained economists, and they can't get within $800 billion of a correct number. So at the end of the day, take it with a grain of salt. It could be 15 years, could be 25 years, could be when I'm long gone, could be. I'm not going to say tomorrow or anything. I don't think it's going to be tomorrow, but these are the kinds of things that happen. One of the things you'll want to pay attention to, by the way, is some of the future debt issuance. So when the the Treasury starts to offer more securities, maybe you need to start paying attention to it. Now, I'm not saying pay attention to the small ones, the 1 year T-bills, the 2 month T-bills and stuff. You don't want to pay too much attention to that because those things go much quicker, faster, short term. There's less risk there. But follow the 10 and the 30-year Treasury issuance or auctions so that you can kind of see or get a feel for what's going on in the marketplace. If the 10-year and the 30-year trouble or 10-year and 30-year Treasury bonds or Treasury securities are struggling to be bought, nothing good can come of that at all. It's all downhill from there. So, sorry it was so long, guys. If you have any questions about everything we talked about, remember my email is rich.robinson.phd@gmail.com. So you can always send me a question, talk about stuff. But and I didn't do any of this to scare anybody. It was one of those shot, and it was a shot across the bow. And it's one of those things that says, wait a minute, maybe we're further down the road in the debt problem than we thought we were. The good news is there are more and more people starting to talk about the debt issue in America. There are people realizing that our deficit is unsustainable at 2 trillion. And by the way, our deficit next year is supposed to be closer to 3 trillion. Some other things to scare you. The government, the rest of this year, it still has about $650 billion of debt to issue. And first quarter of next year, they're upwards of almost $1 trillion. It's not quite $1 trillion, it's about 850 billion. But the first quarter of next year, they got another $850 billion of debt to issue. And again, if they had trouble on this 30-year bond to issue, how much trouble they're going to have, in the first quarter of next year when we might be in a recession type of thing. So things to think about. But other than that, thanks for listening, and we'll see you next time.